Ladies and gentlemen, good morning. A very warm welcome to you all. This is the Edinburgh Investment Trust Annual General Meeting, addressing the company's last financial year to the 31st of March 2026. We are delighted that so many of you have taken the trouble to join us here today. In a departure from the norm of beginning these meetings, we are going to start today with a short video.
The UK stock market might not be everyone's favourite today. There are some fabulous businesses listed here in the UK, some of which are global, some of which indeed are domestic, and you can build a very attractive portfolio full of advantaged businesses in the UK stock market.
Edinburgh Investment Trust was established in 1889.
It's been a pleasure to have been involved in the process that the company has made in recent years.
The portfolio is built on fundamental company research with an investment process that combines discipline with flexibility. The managers aim to build a portfolio of 40 to 50 stocks across the style spectrum.
The Edinburgh Investment Trust owns businesses with powerful economic moat and strong growth.
Delivering strong growth at good margins in strategically attractive markets.
We've deliberately constructed a portfolio that is well diversified from a thematic perspective and from an economic perspective.
Whilst we are primarily bottom-up stock pickers, we need to take into account the macroeconomic backdrop. Our resolute focus remains on owning a collection of businesses we think are well placed to deliver over the next 5 years.
Well, I hope you all enjoyed that, and we're looking forward to building on those messages and explaining more about what's going on in the portfolio and the company as the meeting rolls on. My name is James Mowat, and I'm Head of Investment Companies at Lion Trust, the company responsible for the day-to-day management of Edinburgh Investment Trust's assets. I will shortly hand over to Elizabeth Stamen, Chair of Edinburgh Investment Trust, who is here along with the other 4 members of your board. Elizabeth will open the meeting and chair proceedings. Before I do that, I would like to tell you how the rest of the meeting will proceed. After opening the meeting, Elizabeth will make her own introductory comments and then take us through the day's formal business, including the voting resolutions. We will then have an update on the performance of the company and the underlying investments that it holds on your behalf, some of which you saw a sneak preview of in that video. That update will come from your investment management team, Imran Sattar, Emily Barnard, and Tom Gilby. They are looking forward to giving you an insight into their day-to-day work and investment edge. That should take us up until about midday. We will then open the meeting to questions for both the Board of Directors and the investment management team. And after the question and answer session has concluded, the meeting will formally close, and refreshments and a light lunch will be served back in the room that you all came from just a moment ago. I should add that we also have people watching online. Welcome to you too. They've been able to submit questions as well, and I will sprinkle them in with the Q&A from the floor of the room. But in the meantime, I'm very pleased to hand you across to Elizabeth.
Thank you, James. And ladies and gentlemen, welcome. To add to James's comments, we're delighted that you're able to join us today. As James mentioned, there are also shareholders watching online, so thank you all for your time. Also with me on stage today are my 4 fellow directors. Aidan Lisser, the company's Senior Independent Director, who also oversees the company's marketing activity. Steve Baldwin at the end, who chairs the company's Audit Committee, which, among other things, oversees the production of the company's annual report and accounts that you have all received today. Patrick Edwardson next to Steve, the chair of our Management Engagement Committee, which takes charge of the relationship that we have with our key suppliers, and in particular with our investment manager at Lion Trust. And Annabel Bannerman, who takes the lead in any of the legal and regulatory matters that concern the company. All the directors have made significant contributions over the last year, and I would like to put on record my thanks to them. The time is now shortly after 11 a.m., the time appointed for holding the Annual General Meeting of Edinburgh Investment Trust, as convened by the Notice of Meeting to Shareholders dated 20th of May 2026. In accordance with the company's articles, I will chair the meeting and represent the proxy votes that have been submitted in advance. I confirm that a quorum of shareholders is present, and I declare the meeting open. Before moving on to the formal business, I would like to take this opportunity to say a few words about your company. The financial year to the end of March was another one of good progress across a range of topics for the company. For example, the directors have recommended that dividends per share increase by 11% this year compared with last. And on the marketing and shareholder engagement fronts, we continue to implement a range of measures, including this and other shareholder meetings, to promote the company and to encourage new shareholders to invest. Indeed, it's super to see so many new faces in the audience today. The main challenge over the last year have been investment returns. Despite positive absolute returns, performance when measured against the FTSE All-Share Index has been disappointing. The UK equity market has actually performed well compared to most major peers in the last 2 years, but the company's portfolio and returns have not kept pace with the market. While we accept that short-term returns like these can be volatile, as a board we recognize the importance of returning longer-term investment results back on track where we would all like to see them. We are engaging robustly with the management team and broader executive and non-executive team at Lion Trust to ensure that the investment team, through their process, identify attractive companies that will drive the strong overall results that we seek to deliver for you. In his presentation today, Imran and his team will set out in detail the factors behind recent performance, how the investment process works in practice, and why there is confidence and excitement in the future return potential for the company. With that, we'll now move to the formal business of the meeting. I propose, and given the consent of the meeting present, that the notice of meeting be taken as read. To reflect the views of shareholders of the company accurately, voting today will be done via a way of a poll on each of the resolutions. This is seen as in the best interest of the company and shareholders, as it gives all shareholders the opportunity to participate in the decision-making of the company and have their votes recorded in proportion of the number of shares they hold. The poll will be administered by our registrars, MUFG Corporate Markets. Poll voting cards were distributed when you registered this morning. If you have already lodged a proxy form appointing me as your proxy, and you do not wish to change any of your votes, there is no need to complete your poll card. However, if you wish to change any of your votes, you should complete the poll card for every resolution. I will now move to the resolutions. I propose that each separate resolution, as set out in the notice of meeting and referred to on your poll card, be put to the meeting. You can now see the results of proxy voting on the screen behind me, with all resolutions receiving at least 97% of voting in favour. Are there any questions on the resolutions to be put to the meeting? If you need to, please now complete your poll card by marking how you wish to vote on each resolution and sign it. You can vote in favour of a proposed resolution, against a proposed resolution, or you may withhold your vote. Should you require any assistance, our registrars will be pleased to help you. Poll cards should be handed to the company's registrar at the end of the meeting, and the final results of voting on each of the resolutions will be announced through a regulatory news service announcement as soon as practicable following this meeting. Voting will close 10 minutes after the end of the meeting. That concludes the formal business of today's annual general meeting. I will now hand over to our investment management team, who will provide a detailed update on the company's performance and the underlying investments managed on your behalf. Thank you.
Thanks, Elizabeth. And good morning, everyone. Delighted to be back here again this morning to talk to you about your portfolio. The plan today is to cover 4 things. Firstly, an overview of the trust, how it's managed and how it's performed. We'll then take you through a deep dive of the portfolio, and then we'll discuss our investment process. And finally, I'll leave you with my outlook for macroeconomics, the markets, and most importantly, your portfolio. And what you'll see today is that this is a trust that has high conviction, a portfolio full of advantaged businesses well set to deliver attractive returns going forward. Now, before I start, let me introduce you to the other members of the team. I'm lead portfolio manager, and I'm supported by Emily Barnard as deputy and 2 analysts, Tom Gilby and Gabriel Lever-Grecu. And together, we have 50 years of combined investment experience. This is the team that is responsible for looking after your company. And you'll hear from Emily and Tom a little later. So the first section, an overview of the trust, starting with the objective, a reminder, it is to exceed the total return on the FTSE All-Share Index, our benchmark, and then to grow dividends ahead of UK inflation. Now, we're bottom-up stock pickers with a flexible investment style. And why flexible? Well, just like there are economic cycles, there are stock market cycles, and to be able to perform across cycles, one has to have a pragmatic approach. Now, that said, we do prefer owning businesses that have powerful economic moats, and I'll come on later and talk about what that means exactly. In the long term, businesses that have structural growth and a barrier around their moats gives us the best chance to produce attractive returns for you as shareholders. And then the tilt to growth or value will depend on the bottom-up opportunity set. This is a portfolio that has a total return approach. And for us, that means the focus is not just on income. We know that income matters to you as shareholders, but so does capital growth. We're trying to optimize such that we're delivering attractive total returns. In a nutshell, we're aiming to build a conviction portfolio of around 40 to 50 stocks, principally invested in the UK stock market, but with the flexibility to own up to 20% in non-UK listed shares. And then one of the benefits of the investment trust structure is gearing, and we have good long-term structural debt in place of around £120 million, which should also be return accretive for shareholders in the long term. And for those of you that were here last year, you'll recognize that this approach has not changed. So how have we done? Well, Since we were appointed to manage the trust just over 6 years ago, you can see returns in terms of the share price and the NAV up triple digits. So very nice returns in absolute terms. And then when you look at the NAV versus the benchmark, the FTSE All Share, modestly ahead. So we've met the first part of the objective of the trust. If we move left to slightly shorter term performance, you can see respectable absolute returns in the sense of the share price being up 8.5%, the NAV up 7.2%, but we've lagged the benchmark with the FTSE All Share up 21.5%. So we've struggled to keep pace with the market rise, and I'll come back and talk about the drivers of that shortly. To the second part of the objective of the trust, we look at the dividends here, and as Elizabeth mentioned earlier, the dividend for the year to March 26 was raised by 11% to 32 pence, and that leaves a CAGR, compound annual growth rate, of the last 4 years of 6.6%, thereby meeting the second part of the objective of the trust. Now, before we look at the drivers of performance, it's worth providing some context. UK market concentration has been extreme, and you can see a narrow group of stocks driving the market, some of which we've been either below the index weight or not owned, principally some of the banks and Rolls-Royce, for example. And then when you look on the right-hand side, you can see 82% of the benchmark return came from just 10 stocks, concentrated. Market dynamics have been changing. You've all read about the geopolitical environment that we've been in the last 2 years. And then when you look on this chart on the left-hand side, you can see a very material de-weighting of capital-light businesses versus capital-heavy businesses. What I mean by that is think of businesses that are capital-light as businesses that generate cash and don't have to spend that cash flow on factories and physical assets, whereas capital-heavy industries do use their cash flow to invest in factories and physical assets. So capital-light businesses, software companies, capital-heavy businesses, utility companies, mining businesses, and industrial businesses. And then finally, on the right-hand side, you can see a changing market structure led by value rather than growth. So a tricky market to navigate. So let's break down recent performance. On the positive side, a few stock specifics. Firstly, Anglo American, the mining business, benefited from rising commodity prices, principally copper, and also the benefits that it will accrue from the proposed Teck Resources merger. And then GSK, that's the GlaxoSmithKline business, global pharma company, and Rentokil, the global pest control business, two examples of self-help stories that produced good returns for us. And then Tesco, the leading UK supermarket, delivered the goods again this year. And lastly, Halma, the industrial business, wonderful business that produced very strong profit growth. Now, on the negative side of the ledger, there were 3 key reasons why we lagged the UK stock market. Firstly, several of our data and technology companies were at risk of AI disruption as perceived by the market. Secondly, a small number of holdings disappointed from an operational and financial perspective. And finally, we had low weightings or no holdings in some of the areas of the stock market that performed very strongly. Think of the banks and Rolls-Royce as examples. So I appreciate performance in the last 12 months has been subpar. Our confidence, though, in our investment process, and most importantly in the portfolio holdings that we own on your behalf, remains very high. Now, we're long-term investors with a longer horizon than most. Our confidence is there, and you will see where that comes from and why in the rest of this presentation. Now, given the underperformance, we thought it would be useful to spend a bit more time than usual on addressing the three key reasons why the portfolio performed poorly against the benchmark, to be completely transparent. I'm going to hand over to Emily before I'll come back and take you through the investment process.
Thank you, Imran. Good morning, everyone. So let's talk through those three buckets of underperformance. The first, the AI underperformers. So for context, over the last 18 months, we've seen some significant changes in the market. And one of those has been the notable valuation re-rating of capital-light businesses. Capital-intensive businesses against capital-light. Now, one area where there's been sizable capital spending has been at the US hyperscalers, so Microsoft, Amazon, Google. Those three, together with Meta and Oracle, have committed to spending over $650 billion in CapEx just this year, in an arms race to build out AI-related infrastructure. Now, as we've all been increasingly using the likes of ChatGPT, there has been increasing fear in the market around which companies could be negatively disrupted by AI. Rightmove, Autotrader, and BCG are three internet platform companies in your trust where the market has taken a view that they will be negatively disrupted by AI, and this has contributed to the share prices underperforming over the preceding year. We judge the outcome of AI to be very different for these businesses. So, as most of you will know, Rightmove is the dominant online property portal in the UK. And for every 100 minutes a UK consumer spends on a property portal, about 80 of those are spent on Rightmove. So it has very high consumer mindshare. And that consumer mindshare is being cemented with innovation and partnerships. And they've recently announced a strategic partnership with NatWest, the UK bank, where a consumer on Rightmove will almost instantly be able to get a mortgage in principle decision when applying through Rightmove, and then potentially an mortgage offer within 24 hours. So that consumer mindshare and that convenience are very hard to displace by an AI tool. The second factor protecting Rightmove's position is the quality of its data. Now, for an AI tool, the context you provide it and the data you provide it are really key in getting a usable and useful answer from an AI tool. And with Rightmove, about 50% of the data it holds on properties on the portal, that data cannot be scraped by an AI tool. So these tools do simply not have the same depth and breadth of data as Rightmove does. Now, in Rightmove's specific example, rather than AI being direct competition, we think the most likely outcome is it's a new distribution angle for Rightmove. And to that point, they've recently launched the Rightmove app within the ChatGPT environment. It's very early days. There's not yet much direct traffic from ChatGPT to Rightmove. But we do think this points to AI being a distribution angle for these companies rather than direct competition. These same factors protecting Rightmove are also present at Auto Trader, the leading online used car portal in the UK, and BCG, Baltic Classifieds Group, which is like the Rightmove plus Auto Trader of the Baltics. We think AI presents an opportunity for them to broaden distribution, improve product innovation, and also improve internal efficiency. And the other company I'll mention here is Sage. Likewise, the market has viewed Sage as going to be negatively disrupted by AI, and this has contributed to share price underperformance. And again, here, we judge the impact to be different. Sage is a global leader in accounting software for small and medium-sized companies. And following a period of investment and product innovation, organic growth has accelerated and the company is performing very strongly. Now, for any business customer, having reliable software suppliers is important, but this is particularly important for small and medium-sized companies, which are likely to be less resourced internally and less able to keep up with changing accounting rules and requirements and reporting. And so Sage here, as a software supplier, helping companies stay in regulatory compliance is very valuable. Sage is already using AI with its own Sage Copilot as a way to improve pricing power. And we think the likely outcome is an acceleration and expansion of the dynamic we are already seeing, which is AI helping product innovation, which improves pricing power, which long-term helps cement and improve customer lifetime value. So that's the first bucket of underperformance, the AI-exposed companies. I'll move on to the second, which is companies which have delivered subpar operating performance. And actually, the unifying factor across all these three companies has been all of them have suffered weak end markets in their respective areas. All of them have seen divisional or higher management change, and all of them have had a few hiccups operationally. So these are Marshalls, the UK manufacturer of landscaping, building and roofing products, Haleon, the global consumer health company, and Dunelm, the UK homewares retailer. Now, Tom's going to speak to you about Marshalls shortly, so I won't dwell on Marshalls, just to say it's been a weak end market. During COVID, consumers spent more on improvement to their homes, and so since then, that spending has been a little bit weaker. In addition, there is a decent chunk of the Marshalls business exposed to the new build housing market. As we know, that has been weak for some time, so a weak market backdrop. In addition, the business was just not executing quickly enough, and they recognise this. There has been a management change and self-help actions are underway. Secondly, Haleon, the global consumer health company. Again, it's been a weaker market backdrop. Principally, the US consumer has been weaker. And then in addition, we've had a weak cold and flu season globally, which has impacted a number of the Haleon products, also impacted competitors like Reckitt. And then operationally, they haven't performed where they should be in the US. So they've made some changes. The head of the US has changed. She's changing a number of her team. They're working on improved product innovation, working on shelf distribution and shelf positioning with retailers. So again, tough market backdrop, management change, self-help actions underway. And then lastly, Dunelm, the UK homewares retailer. The Dunelm hiccups are in the context of very excellent, really, long-term performance. There's been a weaker UK consumer. There's been cost inflationary pressures hitting the business. And in addition, promotional competitors have been somewhat more promotional in recent periods. Now, the two slight own goals at Dunelm have been, there was a furniture forecasting issue within their system, which resulted in availability issues and some lost revenue. That's now been fixed. And then in addition, less of an own goal, but they have been slightly behind the curve on digital, having only recently just launched an app. Now, to be clear, we think digital is a huge opportunity for them. It will require some investment, likely, but a huge opportunity. but this has meant competitors have stolen the march a little bit recently on digital advertising. So the subpar operating performance companies, all under very close watch by us and close interrogation, as you would expect. And lastly, the group of companies where we either hold less than the benchmark in the case of HSBC, or we don't hold the stocks at all presently in your portfolio in the case of Rolls-Royce and Glencore. And as these stocks have done well, it's hurt the trust's relative performance against the benchmark. Not her absolute performance, just relative here. So we'll start with HSBC. Again, a new management team. They've done a fantastic job streamlining the portfolio of businesses, taking structural costs out, and growing their Asian wealth business. We did a full investment thesis reappraisal in January of this year, and then used the weakness associated with the Middle East war as a good opportunity to increase your position in HSBC. And then Rolls-Royce, a company we don't currently own in the portfolio, under close watch for when the valuation becomes a little bit more appealing. Like HSBC, the CEO has led a fantastic turnaround there. And then lastly, Glencore. For any of you who were here last year, you may remember we spoke about Anglo American, which has been one of the top contributors to performance over the year. Glencore has had similar factors where it's been helped by rising commodity prices, alongside some Glencore-specific activities. So there's three buckets of the AI underperformers, subpar operating performance, and then stocks where we have different weightings versus the benchmarks, all very much under review. The AI-exposed companies, we retain conviction, but have been shifting the mix of those companies towards the highest conviction names. The subpar operating performers under very close interrogation. And then lastly, the benchmark underweights. I should just highlight that as an actively managed portfolio, we are not restricted by the benchmark weight. So you would expect to see some benchmark underweights and overweights, but clearly, where there are stocks that are doing very well, turnarounds going on track, we of course review those. I will now hand back to Imran.
Thank you, Emily. So, what have we been doing in portfolios? And this is just in the kind of last 6 months or so. We've talked consistently about our flexible investment style. And whilst we've had a quality growth bias over the last couple of years and retain a modest quality growth bias, we have found more opportunities in the value part of the equity market, principally through our bottom-up research. And you can see flexibility in action here with many of the recent purchases in the value part of the market. As Emily just mentioned, we found an interesting opportunity to add to the banks, which included HSBC, but also Lloyds and NatWest at the time of the Iran war, which kicked off at the end of February, beginning of March. And the shares were derated, and we've been looking for an opportunity, and that provided us a great opportunity. And then below that, you can see purchases of Ibstock, that's the UK brick manufacturer, and then Sigma Rock, the lime materials business. Both examples of businesses in the construction and house building area where volumes have been depressed and therefore their profits constrained. Now we see lots of value in both of those names, as we do in Marshalls, which we also hold. The opportunity is that if there's a recovery in house building volumes and construction activity, both of these businesses will benefit very materially in their profits. But over and above that, you're also likely to see a re-rating. So we're very excited about those names, but recognize that construction activity remains constrained today. And then in the data tech area, which Emily talked about just now, we found an opportunity to add to Softcat. Softcat is a value-added reseller that helps medium-sized corporates to spend their IT and tech budget. So think about spending on AI, excuse me, cybersecurity, and cloud services. Now, Softcat has been an incredible success story for the last 2 decades. It's been a consistent market share winner, but it's got caught up in the crosshairs of AI disruption that we've just talked about. And we found a great opportunity to add to the position back in February at the peak of AI disruption risk. And this is a great example of how fickle the market is around this issue. Because last year, Softcat was an incredible business. It's got an incredible track record, and it's very much a loved share by the stock market. And then in February, it gets de-rated very, very materially, and the stock market doesn't like it, and the shares decline rapidly. But as bottom-up stock pickers, we see that as an opportunity, and so we added to the position. And what we've seen since February is the shares have bounced of the order of 50 or 60%. And so a great example of how fickle the market is. Yesterday, it's a great business. In February, it was a really bad business, and now it's a great business again. Opportunity for us as stock pickers. And then we added to BAE Systems, the defense contractor. The sector had been weak, the shares had been weak, and we found a good opportunity to buy some shares in BAE. And then finally, to the discussion we had earlier about capital light and capital heavy businesses, we found a good opportunity to buy, so rather add to the position in Shell, the oil major. Clearly, the high oil price means that this business is generating huge amounts of extra cash flow, and capital discipline, by the way, we've been very impressed with, and it remains an attractive holding for the trust. And lastly, Weir, that's the mining equipment and parts business. Again, a great example of a high quality business. Shares have been weak on the back of modest earnings weakness. We found a great opportunity to buy an excellent business with an excellent long-term future. Moving to the sales side of the ledger, we've reduced some positions in the consumer area, principally through Whitbread. That's the owner of Premier Inn. Now, to be fair to the company, it's done a really good job in navigating what has been a tough consumer environment. It's been taking market share in the UK. It has a small German business which was loss-making, is now being turned around, very close to being nicely profitable. Now, all of that said, the investment case got torpedoed by the last budget when the Chancellor raised business rates for companies like Whitbread, and it just meant that profit growth is going to be very, very hard to come by. And as we've said earlier, we're flexible investors. The investment case has changed, and we've sold the position down. We also trimmed the position in Greggs. Again, whilst we like the business and we think the business is well set for the long term, short-term dynamics remain constrained and profit growth will be hard to come by, so we've trimmed the position. And then if you look at the next batch of stocks, AJ Bell, Diploma, and Halma, we've reduced all of these positions on the back of significant share price strength and a re-rating of their profits. And it's just a good example of valuation discipline, because all three are wonderful, wonderful businesses, but valuations have increased materially and we've trimmed the positions back. And then going back to the data tech area, we've sold the position in Trainline and reduced the position in Money Group significantly on the back of higher conviction in the names that Emily mentioned earlier. So the likes of Softcat, Sage, RELX. Now these examples demonstrate flexibility of our investment process and our focus on bottom-up stock picking. The process hasn't changed, but the opportunity set has, and the portfolio has adapted. We've added selectively to value and cyclical areas of the market while still keeping exposure to the high-quality businesses that we believe in the long term. So, let's move on to the next section of the presentation, which covers a deep dive of the portfolio. Now, we aim to ensure the portfolio is well diversified across themes and the economic pie. And for those of you that were here last year, you know that we have two lenses with which we look at the portfolio. Here's the first one, a thematic lens. These are the key themes that run through your portfolio. And we're aiming to construct a portfolio that is driven by multiple themes rather than just reliant on one or two. It's very much deliberate to have multiple themes driving the portfolio. Let's have a look at some of them. So market champions there on the left-hand side in orange. Take Tesco as an example. Its advantaged market leadership position is making the business stronger and stronger. That scale is improving its supplier position, which gives it better pricing, which allows it to win more and more customers. So it's really pressing that competitive edge. Top right in turquoise, we talked about GSK and Rentokil. Those are two really good examples of businesses that have internal plans that are driving their profit growth. And then bottom middle, what is that? Salmon, data and analytics, about 11% of the portfolio. It still remains a key theme in the portfolio, even if we've actively reduced the size of that theme, concentrating our positioning on the ones that we really believe in, the likes of RELX as an example. And RELX is a fabulous business with very powerful data sets that, if anything, is getting stronger and stronger with analytics and AI overlays. Now, as I said, there's a second lens with which we look at the portfolio, and that is how well is the portfolio diversified from an economic pie perspective. For us, this is really important rather than simply looking at what the portfolio looks like versus the benchmark. And you can see that there's a very broad spread, and that's very much deliberate. Starting from the left, you can see exposure to defensive positions in companies like National Grid and Compass. And as you move right, you can see exposure to some of the structural growth areas in healthcare and technology. So in healthcare, the likes of AstraZeneca, GSK, and Haleon. In technology, it's the likes of Softcat and RELX. And as you move further right to some of the more cyclical areas of the market, you can see exposure to commodities. That's the Anglo Americans and Shells of this world. In financials, it's the banks plus Admiral Group. And then as you move further right, industrials, Rotork, Halma, and Weir. Rotork, by the way, received a very nice bid approach last week at a 7% premium to the undisturbed price, which we are delighted by. And then finally, consumer, Howdens, Dunelm, Greggs. You can see this is a very well diversified portfolio across a range of sectors, and that's very much deliberate. Right at the beginning, I talked about building a conviction portfolio full of advantaged businesses and one that aims to perform across market cycles. By looking at these two lenses, you can see that we have an exciting portfolio that's well set to deliver attractive returns going forward. So on to the third section, the investment process. I talked earlier about our flexible approach, and that's why we look at a wide range of opportunities: growth, value, cyclicals, defensive businesses, self-help stories. Now, that said, over the medium to long term, high return companies with an economic moat are best positioned to deliver attractive returns. And just a reminder, for those of you that weren't here last year, what we mean by an economic moat is how a company can maintain its structural advantage. If you've got high returns and an attractive business, there will be capital that tries to compete against you. And so therefore, having some sort of barrier around your business is your best chance at protecting those returns. So we spend a lot of time thinking about the economic moat of a business. It's important, that said, to be pragmatic, and we find interesting investment opportunities across the spectrum. Some will be growth companies with an economic moat, others will be deep value companies. Moving to the right, portfolio construction plays an incredibly important role in how we run the trust. And for us, that means a number of things. Firstly, it's about ensuring the portfolio is economically diversified and thematically diversified, as you've just seen. It also means thinking about macro considerations, because companies don't operate in a vacuum. And for us, we think about macro from the micro being the principal way about how we learn about what's going on at the macro level. And what I mean by that is we tend to meet lots and lots of companies, and they're very close to the ground, so they know what's going on, and we build a picture. It's almost like building a jigsaw puzzle to work out what's going on in the economy. And then another important factor in delivering good portfolio construction outcomes is making sure that the team is debating portfolio positioning and having that constructive criticism and challenge from the whole team. So the team not only spends time thinking about stock specifics, but also the shape of the portfolio. Careful risk management guardrails are in place, and that comes from a number of things. Firstly, it's my experience of looking after portfolios for nearly 3 decades. It's quite scary when you say it that way. Secondly, it's about that portfolio team debate and challenge. Thirdly, it's from the risk team internally at Liontrust. And finally, and this is an advantage of the investment trust structure, it's the board oversight that we have that also looks at risk. And then finally, valuation. It's an important part of the process, but it deliberately comes at the end of the investment process, not the beginning. That, in a nutshell, is our investment process in running the trust. And this is a process that's unchanged since we started to look after the trust just over 6 years ago. But like all good teams, we look to iterate and hone the investment process and make it better and better. Now, here's a bit more detail, but I'm sure you're all glad that I'm not going to spend the next 2 hours taking you through all of this detail. Now, that said, what we do like to do is zone in on one aspect of the investment process. And this year, we've decided to talk about how we think about self-help. So Emily and Tom will take you through the detail and bring it to life with some examples before I come back and finish on the outlook for the portfolio. Emily.
what do we mean by self-help? Self-help refers to companies going through a turnaround, where perhaps there were operational or strategic missteps, and now those missteps of the past are being corrected. Self-help strategies are usually designed to improve growth, margins, and returns of the company, and can sometimes also include balance sheet repair. Whilst clearly every self-help turnaround is unique, there are some common elements we see in self-help turnarounds across industries. They usually start with an identification of the issues, and usually a profit warning, a cut to numbers, and a reset of expectations. Quite often, they can follow with a few more profit warnings, as the true depth and breadth of the issues facing the company are uncovered. You can quite often see management change. Perhaps the management change is the catalyst for the issues being uncovered as the old management team leaves, new management team come in and find problems. And sometimes the existing management team can run into some missteps and be determined not to be the best placed people to then deliver on the turnaround. The new management team will come in, set out their stall for recovery for the business and the share price, and then ideally you get to a point of share price and underlying company recovery and improvement. Now, self-help stories can be very powerful, as you can have both an earnings inflection and a valuation re-rating when they work. They can also be nice idiosyncratic sources of upside for a portfolio, and that can be nicely diversifying. Now, Rentokil is a great example of a self-help stock in your portfolio, and it's been one of the top contributors to performance over the last 12 months. Rentokil is the global leader in pest control, and up until 2022 had a great track record of compounding earnings and free cash flow, and as such, it was pretty handsomely rated by the market. Rentokil had delivered on both excellent organic growth and also consistent bolt-on M&A. Now, pest control is really about what's called route density, getting as many customers as you can in the same set of geographic locations, and then having the same group of engineers and technicians service those companies. Route density is a great way to improve margins. And so in that context, bolt-on M&A, buying up small family-owned businesses and brands, has been very accretive for Rentokil, and they've executed on it really fantastically. So what happened in 2022? Well, at the end of 21, Rentokil embarked on its largest ever M&A deal, spending just shy of $7 billion to buy one of their competitors, Terminix, in the US. This was a strategic deal and much larger than the bolt-on M&A the management team had built their track record on. This would take Rentokil from the third largest player in the US to the first, with 30% market share. And we'll focus on the US because it's about half the global market in pest control and the largest single market. This transaction was not just about bringing branches together, getting synergies. It was about taking Rentokil's execution playbook and applying that to a Terminix business which had been underperforming peers. Unfortunately, the integration has been more difficult, complicated, and costly than was initially envisaged. So let's take a look at the Rentokil share price over the last 5 years to see how the turnaround has unfolded. We start in mid-21. Excellent track record, shares have done very well. And then in late 21, the announcement of the Terminix deal. This was a strategic shift for the business, and it was not taken well by the market, principally around valuation, paying just shy of $7 billion for the deal. We then go through to October 23 and the first major profit warning. Issues were uncovered, new customer acquisition had been weaker than expected, and there was a cut to numbers and a reset to expectations. We then started to build your position around January 24 through to October 24 were the main purchases. The second profit warning comes towards the end of 24, around September. There was a further uncovering of issues and a further cut to numbers and expectations. And these issues were really in 4 categories. Continued weak new customer acquisition. That planned branch integration between Terminix and Rentokil was not going to plan, and it was causing disruption to operations. There were some cost overruns. And then, as to be expected, there were some personnel issues bringing 2 sizable organisations together. Around this time, an activist investor had also built a stake in Rentokil. They had a representative appointed to the board, and then a short 2 months later, the CFO announced his retirement. So this was the first major change in that bucket of management and strategy change. We then have a further disappointing update to the market where there was a further identification of issues, this time around branding. And so they changed their approach to branch integration and branding. We then have a further management change. So there's a lot going on at Rentokil. And this management change was the long-standing CEO announced his retirement. And importantly, there was additional brand and marketing expertise added to the board, as this had been a core problem for Rentokil over the last couple of years. The share price and the business then entered a period of recovery. And the situation today is we have a new CEO in situ. He's been in situ for around 4 months. We have a new chair joining towards the end of this year, and a new head of the US is also joining in a few months' time. Now, the next time we will hear from the new CEO will be next week when they report half-year results. And one of the key questions is, as new CEOs can sometimes do, will there be a tweak, an update to the strategy? Could there be a further cut of expectations and numbers? Now, the prior slide almost showed a turnaround as a straight line process. Clearly, that's not how it works in practice. And turnarounds can often be more like a spiral where certain stages are repeated. So you see multiple periods where issues are identified, multiple periods of strategy tweaks and management changes. So recovery is more like a spiral and less like a straight line. For Rentokil specifically, we think a lot of the hard yards have already been taken by the business, and we remain excited about the further recovery potential in both the business and the shares. Rentokil has a great market position, operating in a growing industry with attractive long-term drivers, but clearly where most recent execution has been much weaker. So we're excited, but recognise it can be more like a spiral and less like a straight line. And those self-help turnarounds, as you can see, do require patience and good timing, both for company management teams and for investors. There are a number of other really exciting turnarounds in your portfolio, which I will hand over to Tom to speak about.
Thanks, Emily. So to continue the self-help theme, I'm going to talk to you about Spirax. Spirax is an industrial engineering business operating across 3 divisions. 1 focused on steam, 1 on electric heating, and 1 on specialist pumps and tubing. These areas might sound niche, but they are vital to the customer. So like Rentokil, Spirax has historically been a high-quality compounder with a long-term track record of organic growth and consistent cash returns. But over recent years, Spirax has lost its way a bit. Importantly, we don't believe the underlying quality of the business has changed. Instead, management are addressing these issues in order to return Spirax to the high-quality business that it has been. Before having a look at the individual divisional changes that management have made, it is worth addressing the cultural change that has happened across the whole organisation. Management have reduced layers, changed sales incentives, shortened decision-making time, and this has really made the business more focused and more agile. So, within the divisions, the biggest self-help opportunity exists in electric thermal solutions, which provides electric heating systems and temperature management solutions for industrial applications. In recent years, legacy projects and operational issues have weighed on profitability. But these legacy projects are now largely phased out and the operational issues have been addressed. Additionally, lead times have been reduced, execution has improved, and a dedicated sales force has been introduced. Together, these changes will result in better volumes, which, when complemented by a pricing opportunity and the resolved legacy issues, will result in profitability growth in this division. The next division to discuss is Watson Marlow, which provides specialist pumps and tubing. So this business has also suffered a profit fall in recent years as biopharma customers have worked through excess inventory which was built up during the pandemic. But we don't think the long-term drivers have changed at all and they remain attractive. Instead, we think this is a temporary issue. Management have used this time to reorganise the sales force, invest in new products and add new capacity. So when inventory levels do normalise, Watson Marlow will be in an even better position to grow. And then the final division is Steam Thermal Solutions, which helps customers use and manage steam more efficiently. There have been some leadership changes within this division as well, and the US distribution model has also been adjusted. The aim is to really make the business able to generate more of its own growth through customer relationships and solution selling, rather than just relying on industrial production. So alongside these operational improvements, the balance sheet is also in a better position. Leverage is back within its target range, cash generation is improving, and the management are focused on small bolt-on acquisitions rather than large transformational deals. As investors, Spirax has many traits that we like. Niche products that are key to the customer, strong customer relationships, and an exposure to energy efficiency and electrification. We believe the current valuation does not fully reflect Spirax's potential to return to being a high-quality compounder. As these internal changes that management have made come through, we think the company is well placed to deliver consistent organic growth, margin expansion, and attractive free cash flow generation. And if industrial production also improves, then Spirax will do even better. So the second company I want to talk to you about is Marshalls, which, as Imran has already mentioned, is exposed to the UK construction market and is a recent addition to the portfolio. It is one of the UK's leading manufacturers of building materials, and some of you may know the brand for paving, patios and driveways. Like Spirax, it also has 3 divisions: landscaping, roofing and building products. Across these 3 divisions, Marshalls is exposed to UK construction, house building and repair and maintenance activity. The market backdrop has clearly been tough here. Housing volumes are weak and consumer confidence is low. But what we think makes Marshalls interesting is that this is not just a market recovery story, it is also a self-help one. The core issue has really been in the landscaping division. Historically, this is a significant contributor to group profits and was perceived as a high-quality division. But in recent years, pricing became too aggressive, the product range too complex, and customer relationships worsened. This, alongside the tough market backdrop, has resulted in profits falling from around 60 million to essentially 0. But a new CEO has been appointed and management are addressing these issues directly in three main ways. First, they're simplifying the business. Reporting lines have been streamlined, accountability is clearer, and decision-making more focused. Second, they're improving commercial execution. Marshalls is focused on rebuilding customer relationships with merchants and contractors, and pricing is becoming more balanced, competitive while still maintaining margin. And third, they're improving efficiency. In landscaping, management have removed around 11 million of annualized costs, reduced the product range by around 30%, and are focusing CapEx on nearer term returns. This means that the landscaping division does not need a strong market recovery in order to restore profit in this division. If volumes simply stabilize, then cost savings, better pricing, a simpler product range, and stronger customer relationships will result in profit growth in this division. So what about the other two divisions? Roofing is performing well, driven by strong demand for solar products. The building products division remains a good business, but it is more reliant on a market recovery to drive profit growth from here. So the upside really comes in two stages. First, you have the internal self-help opportunity within landscaping, and this should drive profit growth within that division. Then, if the UK construction market eventually improves, then the wider group will benefit from strong operational gearing and subsequent profit growth. We believe the business is trading on a low multiple applied to what is a cyclically depressed earnings number. We think this gives a very little credit for the internal changes that management are making, let alone the potential benefit from an eventual market recovery. So in summary, we think both Marshalls and Spirax are attractive self-help stories, but in slightly different ways. With Spirax, the opportunity is to restore a high-quality business to the level of performance it has historically delivered. With Marshalls, it is a more value-orientated idea, where earnings are depressed and little credit is being given to the internal improvements underway. In both cases, management are taking clear actions in order to improve profitability, and if their end markets do improve, then this will provide an additional tailwind to earnings and returns. Thank you, and I'll hand it back to Imran.
Thank you, Tom. The final section of the presentation covers our outlook for the macroeconomy, the market, and most importantly, your portfolio. It's fair to say there's a lot going on. You can see that from the headlines on the left-hand side. We've had more than our fair share of prime ministers in the last decade, with a new one yesterday. Sentiment around the UK has been poor. And then when you look on the right-hand side, you can see GDP growth stubbornly below trend for a period, if you X out the COVID period. Now, if you look at UK real GDP versus the G7, actually we're in the pack. And so the weak below trend growth is not specific to the UK. It's a function of relatively mature economies. On the right-hand side, you can see in the context of what is high total debt as a percentage of GDP amongst the G7, actually we fare really well. We've got the second lowest level of total GDP. What total debt rather. What total debt means is government debt plus corporate debt plus household debt. And the real driver, which I think is very impressive, is that reduction has come principally from consumer and corporate, where balance sheets are very strong. So growth is in the pack, and we have a relatively strong balance sheet position, at least at the corporate and consumer level. That's a good starting point for UK equities, particularly given the low starting valuation, which we've talked about previously. Perhaps with a stable political environment, the UK stock market might be a favoured one going forward. Now, it's not dissimilar across the globe. You can see on the left-hand side here, US consumer sentiment is poor. So the weak consumer environment is not specific to the UK. And remember, the US economy is growing faster than the UK. And you can see the inflationary impact from memory and chip prices on the right-hand side. Again, that will put pressure on the US consumer. So the tough US consumer environment is not that dissimilar to what we see in the UK. Let's have a look at some more charts. Emily talked about this earlier, the hyperscaler capex. This is a positive. Large amounts of cash flows from the likes of Meta, Google, Amazon, and Microsoft being spent on compute and data centers. And on the right-hand side, you can see a US economic cycle that is now in its 7th year of expansion, 6th longest in history. So the picture's mixed. The UK economy is not booming, nor is it uniquely weak. Against that backdrop, we think UK equities are really well positioned, particularly given the valuation. So, yes, we've had a tougher 12 months, but our confidence going forward comes from the companies that we own on your behalf. 77% by weight that have been at least beating profit expectations. And a portfolio where the premium valuation has shrunk from about 5 points to about 2 points in terms of PE ratio. And yet the portfolio returns and growth remain very attractive, as I'll show you in a moment. So the economic weather may change. Our confidence comes from the portfolio holdings that we own on your behalf, the majority of which are absolutely delivering financially, operationally, and strategically. Some of these are domestic nature. We talked about the banks and Softcat, for example. Some are global in nature. That's the likes of Spirax, Rentokil, and Weir. In this context, our focus remains firmly on the bottom-up stock picking. So to conclude, the Edinburgh Investment Trust is a high conviction portfolio. Firstly, the trust owns advantage businesses, and you can see that in terms of the return on equity and the margins versus the benchmark, the FTSE All-Share. Secondly, portfolio holdings are delivering attractive profit growth, nicely ahead of the market. And thirdly, the portfolio demonstrates resilience. Look at the leverage versus the market, and also from the thematic and economic diversification that I talked about earlier. Excuse me. The valuation of the portfolio is attractive. Yes, it trades on a premium, as I referenced earlier, but actually when you look at it on a cash flow basis, free cash flow yield, the valuation metric is broadly on par with the benchmark. And that just means that the companies we own on your behalf are converting profits into cash flows much more effectively than average. So in owning shares of the trust, you're owning a high conviction portfolio trading at around a 8% discount to net assets and a portfolio that's well set to deliver attractive returns going forward. That concludes the formal part of the presentation, and I'll hand over to James to host questions that you may have.
Thank you, Imran. Thank you, Elizabeth, for the first part of the meeting, and to Imran, Emily, and Tom for the presentation that follows. So we have time for questions from the floor. There are some roving microphones ready, so if you have a question, please wait for the microphone to come to you. As I say, the questions can be for both the board of directors and for the investment management team, or me, or any other of the company's representatives and advisors here in the room today. So the floor is open. All right, I think we have one in the front right. Thank you. Yes.
Right. Well, last year I congratulated the board, possibly because it was the first time I was invited in 20-year membership to come to the AGM. But this year it's very much a mixed bag. I think the board would agree with that. The pluses are the dividend increase, welcome. The discount, slightly narrowed, welcome. I do scrip dividends, so the share price personally doesn't affect me a lot. I might be picking up a bargain this year, who knows. But I have to say, for other people, the share price is an issue. Is the negative part of this.
Excuse me, could you just speak into the microphone?
The share price is not great. I think you would agree the last year. And I can live with it, as I do scrip dividend, and maybe other people are not so happy. But I would suggest next year, if we're facing the same situation, that I think it's a matter of concern for the board. Now, I heard you had a vigorous discussion with your pop pickers, but I think it's a mixed bag this year, in all honesty.
Yeah, I'll just briefly comment on that. Thank you very much for raising that. As you will appreciate as a board, as I mentioned earlier, we will very regularly engage with the manager, in particular, given the performance in the last 12, 18 months. We've had, both in board meetings and in between sessions with them, because we feel obviously it's in shareholders' interest to make sure that returns come back to what we've been seeing over the last 6 years. So the good news is that over the last 3 months, performance has stabilized. So obviously we hope it will continue that way. You've heard what Imran and team have done in order to adjust the portfolio. So might ask Patrick just to very briefly comment. He chairs the Management Engagement Committee.
Yeah, I'm not sure there's a great deal to add there. I mean, I'm speaking now as a shareholder as well as a director, and I agree with you. But I think the managers would agree with you as well. To some extent, it's going to come with the territory. There's going to be good years and there's going to be bad years. And particularly over what is a short time period, just 12 months, none of us have great control on exactly how things are going to be delivered. But we are very aware of it, and I come back to opening comments. I agree with the point you've made.
Okay, thank you. We have a question on the front row, third row back. Thank you. Yes.
Yes, it's Winston Collins. What it is, I'm a bit concerned about the UK market and in particular investment trusts being out of fashion. And I did notice when you do the research, the number of UK companies in the FTSE index has come down in 10 years from 2,300 to 1,500. And I'm concerned that with that, as UK investment trusts have gone out of fashion and we're not in the market, as you might say, compared with global trusts. I'm also concerned that that AstraZeneca are delisting possibly in the next couple of years, and also Unilever. And perhaps instead of being a UK dominated, which probably always will be, but to market as a European investment trust rather than a UK, and whether the UK All Share Index is particularly relevant. Thank you.
Okay, thank you. I think that one could go both in the direction of the board and the manager. I might suggest, Imran, you comment first, and then if anyone would like to come in on the board afterwards, we'll go in that order. Imran.
So there's a number of points in that question. I guess the first thing is you're absolutely right. The number of companies listed in the UK have been declining. But that's not specific to the UK. If you look at the US, it's exactly the same chart. So it's a global phenomenon, not a UK specific one. And then in terms of AstraZeneca and Unilever, a lot of companies are thinking about where the optimal structure is and where their listing is. But as we stand today, both retain their primary listing in the UK. And we think that the UK stock market is a first class to have your listing, given the accounting standards, given the open nature of the stock exchange, the great corporate governance that comes with being listed in the UK. So there's some big advantages of being listed in the UK. The one that I would accept is the more challenging one is the valuation, because you can clearly get higher valuations if you list in the US.
Would anyone on the board like to add anything further to that?
I mean, I think, again, it's a fair point. You were making, pick up one of your observations on UK trust out of fashion compared to global trusts, if I heard you right. But what I hope you've heard today is the excitement Imran, Emily, and the team, and Tom have about possibilities for the UK. I mean, I'm sure a number of you are invested across a range of. I sit on an emerging markets trust as well. Well, if any of you are involved in that world, the last 5 years we've been out of fashion, and yet in the last 18 months, you'll probably been aware, it's been a rather different ride. So I think the point is that what you've heard this afternoon, the UK is poised for a return. So fashion changes.
Just a small thing to add on to what's already been said, but the approach that Imran and his colleagues take, the approach that we've asked them to take, is to pick 40 to 50 companies from the UK. I don't particularly like the direction of travel of companies leaving the UK and going elsewhere or being taken private, but nonetheless, on your own numbers, we've got 1,500 to choose from, and if we're picking 40 to 50, there's still a pretty good choice there and some very good companies to be investing in. So I mean, personally, I'm pretty optimistic about what those companies can deliver.
Okay, good. Thank you, everyone. Question in the middle at the back, gentleman with the jacket on, and then the gentleman in front. I'll come to you next.
Yes, good day to you. My name is Mark Watson. I'm a private investor. I bought into Edinburgh Investment Trust in November 24, 23, and I did the same thing, same amount, for City of London Investment Trust the same day, and City of London's up 41.4%, and you're up 18.3%. So from my perspective, you're kind of underperforming, and I also notice that you're still at a deficit in terms of NAV, and they're at a surplus. And I also note, and this is really more a question for the board, but their charges are quite a lot lower. So their charges are coming in at, yours are coming in at roughly 0.5%, and theirs are coming in at 0.36%. So at the moment, we're paying more for less, and I'm a bit uncomfortable about that. So I'd be grateful for your comments.
Okay. All right. Well, there's a number of ways we can take that one. I think first, in terms of the performance point, Imran in particular has talked through that, and indeed Elizabeth talked about that in her opening statement, and there was a question about that earlier. So I hope that the period that you talk about from November 24 does largely cover or covers a substantial amount of the performance that report that we have talked to today. Yes, agreed. Imran, would you like to talk a little bit more about any other factors that preceded the 12 months?
Well, I just say that, as Patrick said, performance essentially doesn't move in a straight line. We've had nearly 5 years of very strong performance since we took over the trust. But yes, we've had a difficult 12 to 18 months. Like you, we're disappointed. But the excitement going forward is from the portfolio holdings, as I talked about in the presentation.
And then on your second and third part of your question about the discount and the costs of the trust, I think, again, we speak to the board regularly about that, but clearly that's one for the board to answer. I think the question was directed to them, so I'll hand the cost to perhaps Elizabeth.
Well, or I can take it. I think the ballpark figures that you gave there are correct. I'm not going to dispute them. I think at 0.5 or so for the cost of this trust, we will try and bear down on costs as much as we can. But I think by some distance, the more significant issue there is in the portfolio performance that has been delivered. And in a way, I think your line of questioning is similar to the opening question that we had. Has it been good or satisfactory? No, it hasn't. Are we comfortable with that? No, we're not. But I know that the managers aren't comfortable with that either, and we're all making best efforts to try and deliver a better result going forward.
And then there's a question from the gentleman in front in the row before with the tie. Mike's coming from your left.
Yes, good afternoon. My name is Bill Cant, and I came here with two questions, with one question. But the first one is that I'm a wee bit concerned. While most people will be delighted with a dividend increase, I'm a wee bit concerned about the rate that we're running down the revenue reserve. That's 2 years in a row that we have paid out more dividends than we are getting in on dividends. That can't go on forever, and I was just a wee bit concerned about the size of the dividend increase. Is it really sustainable?
Well, I can perhaps start with a response on that question. I mean, it's a very, very germane question, and we do get asked about it a lot. I mean, to put things in perspective, the cost of the dividend over the financial year was £42.5 million, as set out in the annual report. And the distributable reserves of the company are essentially as set out on the balance sheet, which we won't go into the details of it, but a substantial proportion of the £1 billion that the company's net asset value is effectively available for distribution over the long term. That's not the intention, and at the moment the dividend is covered by about to the tune of 83%. So of that £43 million, 83% is covered by underlying income from the trust. So there's a 17% gap, and that is not quite good enough to work out 17% of 43 million, but it's not very much relative to the size of the company. So it's a small proportion of the company's assets are being paid out to supplement the dividend, but it is something that we certainly do discuss with the board and take into consideration. And there's a range of other factors that we do think about there, including, for example, the fact that the companies in which Imran and the team invest both pay out dividends back to Edinburgh, but also do things like share buybacks as an alternative way of returning capital to shareholders, and we take factors like that into consideration as well. Does anyone have anything further to add to that topic?
I mean, the only thing I would add, so if you invest across a range of different investment trusts, you'll find that using revenue reserves to pay dividends is quite a usual practice for investment trusts. In fact, we've sort of done some analysis just comparing Edinburgh Investment Trust to other, especially UK income-focused investment trusts, and we're probably on the more conservative end. So there are some competitors who actually even go to capital reserves to pay dividends, which is something we have not done. So we certainly, as James said, consider this very carefully every time we think about a dividend. I mean, there are some shareholders who regularly will say, why don't you pay a higher dividend? And we always say, for us, it's the total return approach, which is the most important. So rest assured, we're taking this very seriously and think very carefully about before we decide on what to pay in terms of dividend. But thank you for the question.
Any further questions in the room? Yes, thank you, gentlemen. Back left as I look down. Yeah.
Hello. My name is John Burke. I'm a private investor. Just really for interest, I see there's quite a significant shareholding in Kone, the Finnish lift company, which by chance I know a little bit about. But I'm interested generally in where the company or the investment trust is choosing to buy a non-British share. Is there kind of a structure that it uses to say, okay, we need to have something in this area, and this is the company we're going to choose? There's no sort of clarity that I can see as to why we've done that particular purchase. I don't have any problem with it, but I'm just interested in the structure of the decision making.
Okay, one for Imran, I think.
Thank you for the question. I'd say we don't have a strict formulaic process of investing in international names. You'd expect the vast majority of the portfolio to be invested in the UK, and that will be at least 80% as per the overview that I talked about right at the beginning. We do find interesting investment opportunities as we are researching, the companies and the markets that we look at, and occasionally we find an interesting international name. And if it fits with portfolio construction, and if it fits with some of the thematics that we're trying to play in the portfolio, we can occasionally use international exposure to get access to companies that might not be well represented in the UK stock market. As it happens, we only have about 2% of the trust assets invested in international names. You picked up on one of those, which is Kone. The other one is Verisk, a US insurance data business. But the vast majority, approximately 98% today, is invested in the UK stock market. And actually that's very much deliberate because we have used that 20% more extensively in the past. Today though, we're just finding fabulous, interesting, heterogeneous investment opportunities listed here in the UK. That means we're not having to build investments outside of the UK.
Good. Okay. Any other questions? As I said earlier, we have people watching online as well, so there are questions from beyond the room, shareholder questions from beyond the room as well. There is one I thought was a good one, which is to the effect of, we now have a new Prime Minister and a new Chancellor of the Exchequer. Is that good news for the UK stock market?
I tend not to have strong views around what politics means for markets. I say there's a few things I would say. Firstly, don't forget the UK stock market is very much global. Nearly 80% of profit comes from outside of the UK. So that is the first consideration. I think the second consideration is, and I talked about this earlier, we've had more than our fair share of political change. It would be just quite good for the economy and the stock market to have a period of stability, no significant changes to policy once the new Prime Minister has laid out his stall, and indeed the Chancellor. I think it's important for UK businesses to have visibility because there's been a lot going on in the last few years, not least cost inflationary pressures and supply chain pressures. That political instability has not been helpful. So at the very least, I'd just like to have some sort of stability, and I think that will be positive for markets.
Good. All right. Very nice. That's a nice turn on to finish. That concludes the formalities of this year's annual general meeting and closes it. As Elizabeth flagged earlier, if you have a poll card that looks like this, please return it to the desk at the entrance to the coffee room, which is where you registered when you arrived. But in the meantime, otherwise, thank you all very much for your attendance and continued support. We ask you to join us for a bite to eat in the room behind. And that closes events. Okay, thank you very much and goodbye.